Hello and welcome to this explainer. Let's just be real for a second. Handing over your hard-earned life savings to a professional can be incredibly stressful. There's a lot of very real, completely valid anxiety when you're trusting someone else with your retirement, your family's wealth, and your ultimate financial security. While today, we are going to take the incredibly strict ethical standards of the financial industry and translate them into an insider's playbook, specifically designed to help you evaluate your financial advisor. Okay, let's dive into this. Have you ever looked at your investment portfolio, noticed all the fees, and thought, wait a minute, who is actually making the real money here? Is my advisor genuinely acting in my best interest, or are they just kind of padding their own pockets with my cash? Honestly, it's the absolute most critical question you as a retail investor can possibly ask. And the answer to that anxiety? It really comes down to just two words: fiduciary duty. Now, I know it sounds like a stuffy finance term, but it's actually the gold standard of the investment world. It is literally your ultimate secret weapon as a consumer. Fiduciary duty means your advisor has a strict ethical obligation to place your interests way above their own. Always, no exceptions. So here is our roadmap for today's explainer. First, we'll hit the foundation of trust. Then we'll look at loyalty over personal gain, fair dealing, matching your unique needs, and strict privacy. And finally, we'll wrap the whole thing up with a printable-style checklist you can take right into your next advisor meeting. Moving right into part one, the foundation of trust. This is the absolute core of the entire financial industry. Because the reality is, if professionals misuse the trust we place in them, investor confidence totally collapses, and honestly, the whole financial market suffers. Trust is the glue holding it all together. Which brings us to the number one rule you've got to remember. In the eyes of strict industry ethics, client welfare always comes first. Top priority. It sits above any personal bonus, and it sits above whatever the employer wants. Your welfare is number one, period. Let's move to part two and see how this actually builds into action. This is the first major duty they owe you: loyalty over personal gain, which really means prudence and care in action. Okay, picture this. You've got a portfolio manager at HDFC Asset Management, and they have to make a choice. Option A is a perfectly suitable investment for their client's goals, but it pays a pretty low commission. Option B is a much riskier product, but it pays the manager a massive personal commission. Ethical conduct says they absolutely must choose option A. If that manager goes with option B just to line their own pockets, they're completely ignoring the client. That is a direct ethical violation of their fiduciary responsibility. And speaking of putting commissions first, you really need to know this term: churning. Basically, churning is when an advisor excessively buys and sells securities in your account, and they aren't doing it to grow your wealth, they're doing it mainly to generate trading commissions for themselves. If you are seeing constant, totally unexplained trading in your account, that is a massive red flag that your portfolio is being used as their personal ATM. It is a direct violation of loyalty and prudence. That brings us to Section 3. Fair dealing for everyone. It means exactly what it sounds like: equal treatment in the market. Every single client deserves equal access to recommendations and fair trade allocations. Now, what's really interesting about this is how early access plays out in the real world. Let's say an analyst puts out a massive buy report on Infosys stock. But wait, an hour ago, before making it public, they privately shared that hot tip with their ultra-wealthy clients. Only now, in the present, do everyday retail investors finally get the info. This means you, the everyday investor, are operating at a totally unfair disadvantage. The rich guys already bought in. This is a major ethical violation. Research reports absolutely must be distributed fairly and at the exact same time so everyone gets a level playing field. You also see this kind of unfairness during hot IPOs or initial public offerings. If a portfolio manager takes 85% of those limited shares and just hands them over to their favorite wealthy clients, leaving everyday retail investors with 5% of the crumbs, yeah, they are completely violating the fair allocation principle. An ethical firm allocates fairly, not based on playing favorites. All right, Section 4, matching your unique needs. Because a great financial advisor doesn't just pick good stocks. They pick the right stocks specifically for you. This is known as the suitability principle. Before they invest a single penny of your money, your advisor absolutely must perform a Know Your Client or KYC analysis. They have to ask you essential questions about your personal needs, your financial constraints, your actual investment goals, and your risk capacity.
Honestly, if they aren't digging into these factors, they literally cannot legally or ethically manage your money.
Let's look at a real-time case study to see exactly why suitability matters so much. Imagine a retired client who specifically needs stable monthly income to live on. The ethical recommendation here is conservative, safe assets, things like bonds or balanced funds. But what if their advisor pushes them into highly speculative crypto assets or leveraged derivatives? That is not just unsuitable, that is a recipe for disaster. The risk level simply does not match the client's profile at all, and it's a severe violation of the suitability standard. And here is a friendly reminder for your own life. Suitability is not a set it and forget it kind of deal. When a big life event happens, say you get married, you retire, or maybe you get an inheritance, you need to notify your advisor. Why? Because they are ethically required to update your profile and adapt your investment strategy so it actually matches your new reality. Okay, moving to Section 5. Honesty and strict privacy. This covers the critical obligations of transparently reporting how your money is doing and keeping your financial secrets absolutely locked down.
Imagine you're scrolling and you see an ad from an investment firm yelling, "Our portfolio generated super sweet 40% returns." I mean, sounds amazing, right? Sign me up. But wait, you really have to stop and ask yourself what they aren't telling you. Misleading ads love to brag about the amazing years while totally burying the devastating years where they lost big time.
And this brilliantly illustrates the exact problem. If they advertise that massive 40% gain, but conveniently forget to mention they lost 25% in year 1 and 15% in year 2, that is extremely misleading performance presentation. Ethical standards demand that data has to be accurate, complete, and totally unbiased. They cannot just cherry-pick the good numbers to make themselves look like financial geniuses. Then there's the privacy side. Professionals have to protect your financial details at all costs. Imagine a wealth manager at a dinner party, casually gossiping about a celebrity client's investment holdings over drinks. That social chatter is a massive breach of strict client confidentiality. Unless it's required by law or the client explicitly permits it, your information must be locked down. This is exactly why big reputable firms like BlackRock, JP Chase, and Morgan Stanley maintain incredibly strict systems for privacy and fiduciary compliance. They know that in this industry, reputation and trust are literally everything.
Which brings us to our final stop, Section 6, your advisor evaluation checklist. We've covered a lot of rigorous standards today, so let's synthesize all of that into a simple, incredibly empowering consumer tool you can actually use.
So the crucial point is this self-defense checklist right here. You might even want to screenshot this. Next time you sit down with an advisor, ask these exact questions. For loyalty, are you putting my interests above your personal commissions? For prudence, are you managing my funds carefully? For fair dealing, am I getting equal treatment as your wealthy clients, or am I just getting the leftovers? For suitability, does this specific investment actually match my personal risk tolerance? And for confidentiality, is my financial data strictly protected? All of this leaves us with one final, incredibly important thought to end on. Take a hard look at your own portfolio and your relationship with your current advisor. Based on this insider's playbook, does your financial advisor truly pass the fiduciary test? Or is it time for a change? You have the knowledge now. It's your money, it's your future, and you absolutely deserve an advisor who always puts you first. Thanks for joining me on this explainer, and I hope you feel super empowered to take control of your financial journey.